from that revenue. They were priced out of the as a drop in the bucket for
$1 million. Their CEO noted they are already average.
The forward-looking guidance should reflect
with high-margin institutions.
I think there are distinct points of convergence in our analysis today.
Saturated, and the customer acquisition.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
On February 26, 2026, following their fourth quarter earnings, Teladoc shares surged 15.05% intraday. And they did it on explosive volume of nearly 12 million shares. That is, more than double the average daily volume. The central question we have to grapple with today, drawn directly from the most recent market microstructure data in the company's financial disclosures, is whether Teladoc's Q4 2025 performance, the massive institutional accumulation we are witnessing, and their strategic pivot represent a fundamental, sustainable business turnaround. Or, on the other hand, does the underlying dark pool short selling, the undeniably weak 2026 revenue guidance, and a shrinking direct-to-consumer user base indicate that this is merely a volatility-driven dead cat bounce? My position is that Teladoc is executing a highly disciplined, margin-centric turnaround, one that the market is frankly just beginning to appropriately price.
And I take the opposing view. I argue that the structural deterioration of their core business is actively being masked by algorithmic off-exchange trading, and that the fundamental picture remains incredibly challenged.
Let's lay the foundation here. When you look at the raw financial prints from Q4, you see a company that is finally getting its financial house in order. They reported a narrowing fourth quarter net loss of about $25.1 million. That is a substantial improvement from the $48.4 million loss in the exact same quarter just 1 year prior. But more importantly, we have to look at where that efficiency is actually coming from. The integrated care segment, which is the absolute bedrock of their business, saw its adjusted EBITDA margins expand to a very healthy 16.0%.
Well, driven largely by changing how they account for visits, though.
Exactly. It's a deliberate shift toward visit-driven revenue arrangements. And the smart money is clearly noticing this shift. In the fourth quarter, Jupiter Asset Management increased its holding by 293.86%. They didn't just tweak their allocation, they scooped up almost 3 million shares in a single quarter. When you combine that kind of institutional conviction with a price-to-book ratio sitting around 0.60, the evidence really points to a deep value play that has fundamentally bottomed out.
I hear those top-line improvements, but you have to look under the hood at the structural deterioration of their most famous segment. The direct-to-consumer mental health platform, BetterHelp, is shrinking rapidly. Monthly active users dropped a severe 19% year-over-year. If this turnaround is as robust as you suggest, the forward-looking guidance should reflect it. Yet, management's 2026 consolidated revenue guidance is remarkably uninspiring. They are explicitly projecting that BetterHelp will contract by anywhere from 0.5% to 7.0% this coming year. Furthermore, that 15.05% price surge on February 26 that you mentioned, the volume mechanics tell a very different story than pure fundamental buying. Institutions are heavily utilizing dark pools to bet against the long-term viability of this stock, using the retail earnings surge as liquidity to short into.
I see why you think that, but let me give you a different perspective on the BetterHelp segment. You are looking at the decline in direct-to-consumer users and calling it a deterioration. I am looking at it and calling it a necessary strategic evolution. Let's talk about what is actually happening in the broader market. The digital mental health space has become incredibly saturated, and the customer acquisition costs, the CAC, have just skyrocketed. Management realized that bleeding cash to chase retail subscribers on social media was essentially a race to the bottom, so they stopped playing that game. They initiated a strategic pivot toward an insurance-based model, and the hard data shows they are executing this flawlessly. They set a target of $13 million in insurance revenue for BetterHelp in 2025, and they hit it.
Right, but hitting a low baseline target is one thing. $13 million is a drop in the bucket for a company of this size, and it doesn't solve the broader revenue bleed.
But look at the trajectory for 2026. They're projecting a massive scale up to between $75 million and $90 million in insurance revenue for this segment this year. They expect an exit run rate exceeding $100 million. Their CEO noted they are already averaging 1,200 insurance sessions a day. This is the why behind the numbers. It transforms highly volatile, ad-dependent revenue into a sticky, reliable revenue stream. It stabilizes the margins. Yes, the overall user base dipped, but they are replacing low-margin, high-churn retail users with high-margin institutional payers. That is the definition of a strategic masterstroke.
I'm sorry, but I just don't buy that. Let me tell you why. You are framing this as a proactive, strategic masterstroke, but the data suggests it is a forced retreat. The direct-to-consumer channel didn't just dip. Paying users collapsed down to 375,000 in Q4. Teladoc didn't choose to walk away from that revenue. They were priced out of the advertising market and lost consumer interest. This means the pandemic-era growth model for direct-to-consumer telehealth is officially dead, and here is the mathematical reality of this pivot. Even if they hit that optimistic $90 million target in insurance revenue, it doesn't plug the hole.
Because of the legacy drag.
Exactly. We know this because management's own overall 2026 guidance for BetterHelp still projects a revenue contraction. If the insurance pivot was truly replacing the lost retail revenue at scale, the segment will be flat or growing. It isn't. The insurance gains aren't even covering the retail bleed. They are just slowing the rate of the crash.
The consumer model. It is pricing in the success of the new institutional model. And when we talk about the market pricing things in, we cannot ignore the massive, undeniable buy-side conviction we are seeing from major institutions. We mentioned Jupiter, but look at American Century companies. They increased their stake by an absolutely staggering 509.23%, adding 2.58 million shares in a single quarter. We are seeing major buy walls being established in the $4.40 to $4.75 range, which corresponds to the 52-week low.
Institutional buys happen for many reasons, not all of them fundamental.
But
Look at the profile of the new entrants. Trex Quant Investment, a highly sophisticated quantitative investment firm, just initiated a new position. When quantitative models and deep value asset managers both simultaneously signal that a stock is severely undervalued, especially when it is trading at a price-to-sales ratio of just 0.36, we have to recognize that the fundamental thesis is changing. They're securing a structural floor because the downside risk has been largely priced out.
I come at it from a different way because you are looking at the 13F filings, but you are ignoring the off-exchange reality, the actual market microstructure where this stock trades daily. The buy-side accumulation looks impressive on paper, but the tape tells a much darker story. Let's unpack what a 60% off-exchange short volume ratio actually means. As of late February 2026, the off-exchange short volume ratio for Teladoc frequently exceeded 50%. On February 27th, the day after that massive earnings rally, it hit 60.25%. Think about what that actually signifies. The majority of the volume isn't hitting the public exchange tape.
But off-exchange volume isn't inherently bearish. It is often just institutional routing to avoid moving the public market price. It's block trading.
It is bearish when you combine it with the short interest data. Let's look at the mechanics here. We have 30.57 million shares held short right now. That is over 17% of the entire float, meaning 17% of all available shares are being actively bet against. And the borrow rates? They are sitting at a negligible 0.30 to 0.34%. What that tells us is that it is incredibly cheap to short this stock, and there is ample availability to do so. The price action you are describing as a fundamental turnaround is heavily manipulated by internalizers.
You mean the market makers?
Precisely. We have to look at market makers, internalizers like Citadel Connect and Virtue Financial. When retail investors see an earnings beat and rush in to hit buy on their brokerage app, these market makers take the opposite side of the trade just to provide liquidity. That hedging activity is what generates that massive off-exchange short volume you are seeing. The institutions aren't just buying the bottom. They are maintaining massive high-conviction short positions because they see the exact structural flaws in BetterHelp that I just outlined. They use that 15.05% retail surge as liquidity to short into,
The public tape is showing you the retail reaction, but the dark pool is showing you the institutional preparation.
I'm not convinced by that line of reasoning because it treats the short sellers as omniscients and ignores the actual operational reality of the company's core business. Let's step away from BetterHelp for a moment. BetterHelp is highly recognizable, but it is not the cornerstone of Teladoc. Integrated care is, and the resilience there is phenomenal. In Q4, integrated care revenue grew 5% to $409.1 million. The U.S. member base grew by 9%, reaching 101.8 million members. Think about the scale of that. That is nearly a third of the United States population with access to their platform.
Access doesn't necessarily mean utilization, though. Having the app available through your employer doesn't mean you are generating revenue for the company.
But utilization is exactly what they are driving with their new technology. In January 2026, they launched the enhanced 247 Care service nationwide, powered by their new Prism platform. This is where we need to look at the why. This isn't just a basic telehealth video call anymore. Prism utilizes AI to surface care gaps, meaning it flags missing preventative care before the doctor even says hello. It integrates health information exchange data so the physician isn't flying blind, and the metrics are astonishing. Over 95% of member concerns are now resolved in a single visit.
Those are impressive clinical metrics, certainly.
They are game-changing financial metrics too. If you can resolve a medical issue in one digital visit 95% of the time, you transition telehealth from a convenient triage tool into a definitive point of care. That completely alters the valuation multiple accompanying commands. It justifies the performance-based revenue contracts they are signing with major health plans. This technological leap is precisely why Bank of America recently upgraded the stock to a buy rating, setting a $7 price target. They see that the margin stabilization in integrated care, driven by Prism, fundamentally alters the valuation math.
That is a compelling argument, but have you considered how that technological upgrade translates into actual financial guidance, or rather how it doesn't? I acknowledge the technological leap of the Prism platform. Resolving 95% of concerns in a single visit is a fantastic operational metric for health plans, but we have to look at how management is projecting that to hit the bottom line. Despite having 101.8 million members, and despite the Prism rollout, management's total 2026 consolidated revenue guidance is basically flat. They are projecting between $2.47 billion and $2.587 billion.
Flat revenue during a major restructuring is often a sign of stabilization. You stop the bleeding before you grow.
Perhaps, but the cash generation is actually regressing. Look at the free cash flow guidance. For 2026, they are guiding for free cash flow to drop down to between $130 million and $170 million. That is a noticeable decline from the $166.9 million they generated in 2025. Management blames working capital builds for the BetterHelp pivot and lower interest income. But what does working capital builds actually mean for the investor? It means cash is tied up in the transition rather than flowing into the business's profit. The analyst community sees through the AI technological hype. While Bank of America issued an upgrade, you have to look at the broader consensus. Citigroup lowered their target down to $6. BMO Capital Markets dropped their target to $5, which effectively prices it below where it's currently trading. They're looking at that flat revenue and declining free cash flow and realizing this is a low-growth asset.
But you cannot look at that cash flow reduction without acknowledging what they did with their capital in 2025. Teladoc successfully retired $550 million in convertible debt. That was a massive overhang that the short sellers were betting would crush the company. By clearing that debt, they brought their net leverage ratio under 0.8x. That is an incredibly healthy leverage profile for a company in transition. So when we summarize the bullish position here, Teladoc has successfully cleaned up its balance sheet, completely de-risking the debt maturity fears. They have established a functional institutional price floor in the mid-$4 range, and most importantly, they have set a clear margin-positive path forward by pivoting BetterHelp to insurance and rolling out the highly efficient Prism technology and integrated care. They are fundamentally a stronger, leaner company today than they were 12 months ago.
And to summarize my perspective, Surviving a debt maturity is not the same thing as generating sustainable growth. Yes, the company avoided a liquidity crisis, but they remain a low-growth asset propped up by high-volatility dark pool mechanics. Their most famous segment, BetterHelp, is actively shrinking. The pivot to insurance, while nice on paper, isn't mathematically sufficient to cover the losses from their collapsing direct-to-consumer channel, which is why 2026 guidance remains so weak. And the sophisticated money knows this, which is why short sellers continue to pile in, holding 17% of the float, short off exchange, fully expecting further fundamental decay.
It is clear we are looking at two different sides of the exact same coin. However, I think there are distinct points of convergence in our analysis today. We both agree that management has successfully executed a vital financial de-risking. Managing that debt maturity was critical, and securing a structural price floor through that institutional buy wall has completely shifted the near-term risk profile of the equity.
I agree with that. The existential threat of the debt has been removed, and that mid-$4 level is clearly being defended by institutional accumulators. Where we remain completely divided is on the timeline and the trajectory. Whether this 2026 outlook represents the painful but necessary beginning of a sustainable growth phase or merely a temporary plateau before the fundamental deterioration in the consumer space drags the valuation down further.
It is a fascinating case study in how market microstructure and high-frequency trading can often obscure fundamental business realities, or, depending on your view, highlight the true sentiment beneath the retail noise. Over the next 12 months, the execution of that $75 million BetterHelp insurance target is going to be the absolute key metric to watch. It will ultimately prove which narrative is correct.
Exactly. We will have to wait and see how the data plays out and whether those institutional buyers or the off-exchange short sellers are the ones caught off guard.
Until then, the debate continues.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!